rates kind of go fast and furious up, and then higher for longer, and then they're beginning to come down. From a market cycle perspective, feels like real estate is going to get some meaningful tailwind as interest rates come down. Now, there's a lot of argument about inflation being too high and the interest rates can stay at the elevated level. I sort of beg to differ because of actually significant deflationary pressures driven by the AI.
Welcome back to the Massive Passive Cashflow Podcast. I'm Gary Wilson, your host. I'm so glad to have you back listening to the show or watching if that's the case in recorded mode. That's great if you can do that. We have a great guest today, Mike Zlotnik from New York. And I've been up there quite a bit. My family up there, Mike, and one of my sisters lives out on Long Island. Another niece is in Midtown Manhattan, one of the performing arts colleges, and another sister out more towards the country, just west of the city. So. And I usually stay at the Marquee Marriott right in Times Square because it's basically, ground zero. I can do anything from there and go anywhere and see the shows and eat at any one of the 57,000 restaurants in New York City. So, but in any case, glad to have you on the show. I appreciate your time. I know how valuable you are and how lucky we are to have you. Looking at your background and interviewing already prior to the show. So first off, a big hearty welcome, Mike, to the show. Thank you.
Thank you, Gary. Happy to be here. Appreciate the opportunity to be on the show. And yet, Marriott Marquis is dear to my heart too. I proposed to my wife many years ago on that spinning restaurant. So definitely know it's a great place.
It is a great place to make a proposal. Congratulations too. So, but in any case, if you could give people a little bit of a background. Like most of us students start off in life saying we're going to be a real estate analyst or a real estate investor. We were going to do something else. But what was the pivotal moment for you? What got you into real estate in the beginning, if you can share that?
Sure. So I'll start with a very short James Bond, from Russia with love. I originally actually not from Russia, but from Moldova. So I'll say from Moldova with love. It was still USSR when I left 1989, came to the United States, lived upstate New York, in Rochester. That's where I settled nice and cold, and went to school in Binghamton, and then spent 15 years in technology. But I moved to the city in 95 or 96. I'm blanking out now. It's been that long. And I've lived mostly in Brooklyn. My switch to real estate was in 2009, actively and passively. I started investing in 2000. Literally bought my first apartment in Brooklyn. And I kept buying more apartments and some multifamily houses just because it was all local, because it was easy to understand. But New York City has never been a cash flow place. It's always been an appreciation place. So long story short, I learned real estate 2000 to start, and went active full time in 2009 and never looked back. And it's been my passion. So all I can say is I enjoyed technology career. It was a lot of fun. But true passion has always been real estate.
Yeah, I was the same way. I started off in computer science and working for the Navy as a contractor. I guess I could tell you, tracking Soviet subs. That's what was my first real job. I didn't know what I was doing. I didn't know what the guy next to me was doing. It was so high.
The hunt for Red October, right? Like in the movie, you probably were on the sub trailing one of those boomers.
Yeah, exactly. So. But in any case, my passion was always real estate. I always loved houses. I love designing them. I still design them today for fun. And just got into investing as a result of going to college. My first year roommate, his name was Socrates. His dad was a Greek immigrant. He showed us how to get started investing all those years ago. And that set the course for my life. But so one thing I want to ask you is, obviously there's a big picture, and then we'll start getting narrowed down to the small picture. But as far as macroeconomics goes, everybody always wants to ask these guys, what do they think is going to happen economically? What's the future look like? And I always tell them, hey, as soon as we think we have it figured out, there'll be some other factor that arises that you can't anticipate. So that's why I always focus on the fundamentals. But fundamentally, what's your take on what's happening today in the world? Not just the United States, but worldwide, and how might that impact people, agents and investors both, when it comes to real estate?
Sure, it's a great question. I'll stick with the U.S. I mean, I've been here only investing in the United States. Some people have wonderful opportunities outside the U.S. Not my expertise, so I'll just talk about what I feel is happening here. So we certainly, if we're recording this in November 2025. We've seen rates kind of go fast and furious up, and then higher for longer, and then they're beginning to come down. From a market cycle perspective, it feels like real estate is going to get some meaningful tailwind as interest rates come down. Now, there's a lot of argument about inflation being too high and the interest rates can stay at the elevated level. I sort of beg to differ because of actually significant deflationary pressures driven by the AI. So AI, which is all over the news, everything is all about AI. But for sure, it is technology. It is rapidly developing and accelerating technology, and technology in its nature is highly deflationary. So I expect that inflation will slow down because of AI investment. Currently, the AI investment continues to build, and it's usually infrastructure investing, creating jobs. But in the long run, there's already significant deceleration in hiring and concerns about AI taking number of jobs. So as folks lose jobs, spending kind of cools, and overall, we could see meaningfully anti-inflationary environment. As crazy as it sounds, right? And then in that environment, the interest rates should be at the lower level than they are today because 10-year Treasury bond is supposed to reflect real inflation, right? On the other side, all countries around the world have the same issue of budget deficits. The U.S. has a problem in many other countries. I think we're a meaningfully better place, but at the same time, some level of inflation driven by printing of debt will take place every year. But if the growth is healthy enough and there's anti-inflationary pressure, we should see low level of interest rates. So it's a long story, long speech. But where are we going to go from here? Well, that'll help, obviously, brokers and agents and the ability to sell, right? Lower level of interest rates should improve affordability for residential housing. So I'm generally pretty bullish on this. Although we've seen number of markets that haven't yet corrected because the rate spiked, the supply side was limited new construction. The prices are high, but the affordability has been low. Now, if you look at the commercial side of the spectrum, and this is where we play every day of the week per se, it's very sensitive to interest rates. So as interest rates come down, I expect recovery and an uptick in the fresh cycle to start and to pick up some momentum with lower interest rates in general. And also, selection of obviously strategies are very important. We've seen very limited supply in certain strategies, industrial, open air shopping. Supply has been very, very limited. There is a renaissance in the United States now, reindustrialization of America, more domestic manufacturing. So we're pretty bullish on that front. Obviously, data centers, which is a whole new area of investment, and it's usually not on the scale we participate in. People who are building data centers, they're spending billions of dollars. They are one of the largest, hyper accelerators and related finance companies. So for most investors, kind of retail folks like us, again, non-institutional players, we're a small institution, in a matter of speaking. It's all about smaller projects that we can get predictable income, reduce volatility, and continue to see where we go from here. So we're pretty bullish on a forward outlook, but it's a cautious bullish because there's still a lot of uncertainty in the world. So long enough of a spiel. Hopefully this gives you a little bit of a picture.
Yeah, it reminds me of the famous term of cautiously optimistic.
Yeah, cautiously optimistic, exactly.
Yeah, but I do agree with you. I love what's happening with the onset of AI, the rapid consumption of AI. I mean, we use it on our team daily now. In fact, I was just using it before our interview here. And we can get very specific with it, and it's not like it's taking our work from us. It's actually making our work easier. It allows us to be more focused and more
Productivity
refined.
gains. Yeah,
Yeah,
that's the main reason, productivity gains. The simplest
yeah,
thing I love about this, I took, we invest obviously in equity and debt, and I took a promissory note instead of paying a lawyer $1,500 to extend a note. I gave the original note to AI, and I asked that, hey, write me an extension to this note,
yeah,
following the same terms, just extended for a year. Guess what? Within, I don't know, a minute, you have an extension
yeah,
contract that would otherwise cost $1,500. That's simple. That's productivity.
exactly. Yeah, we use it too for things like creating spreadsheets and stuff. I mean, some of the administrative stuff we do that, creating videos, writing blogs, and things like that. But really, for me personally, as a team leader, it's more we're using it at the strategic level, strategic planning, SEO analysis, things like that, marketing analysis, and recommendations and plans to execute that I would have paid thousands of dollars for before, had a full-time employee. In fact, I'll just tell people right now, 3 years ago, I had 4 U.S. based employees and some virtual assistants. Now I have no U.S. based employees. My payroll has been dramatically reduced by probably 85%, because of how we're able to use AI with virtual assistants who are just as qualified. And I'm not trying to make anybody upset or scare anybody, because everybody that I let go found other jobs. I help them do that. I help them write their resumes. We used AI for that too. So it's just part of the evolution. So people realize the gains far outweigh any of the concerns. Most concerns are emotional anyway. It's just some people need to just, you know, accept what's happening in the world, adapt to it, move forward and progress. Otherwise, you're going to get left behind. So, in any case, so back to the subject. You mentioned debt and equity funding. I was reading through some of the information, and you referenced mezzanine financing. And so on the show, we have people who are beginners all the way through people who are advanced, and they understand that terminology. But would you mind explaining what that mezzanine financing is, and how does it apply today, and how might investors take advantage of that?
Sure. So to talk about mezzanine financing, we need to talk about a capital stack. Now, this is a technical discussion, but folks should definitely understand that. So
Mm-hmm.
in real estate in general, the most basic capital stack is you have a bank loan mortgage, right? Whether it's residential or commercial, called first lien loan. Some people refer to this as a primary debt. And then you have common equity, which is basically the down payment people put in a house, or an equity investment in a commercial, industrial deal, shopping center, multifamily. That's a simple capital stack with only 2 layers.
Okay.
Quite often, you may have a few things in between. So mezzanine debt or secondary debt, it's the debt that's behind primary debt but ahead of the equity, right? And
Mm-hmm.
sometimes you have also preferred equity. In some connotations or on some deals, they're interchangeable. Some people call mezz debt, some people call it preferred equity. If you have only 3 layers, that middle layer is what middle mezz debt means, or preferred equity. It's created for a few reasons. It's created to provide obviously liquidity for the project that needs a little more capital. There's a gap between what the bank will lend. It's very relevant today, by the way. The banks are more conservative; they're lending less, and then equity investors don't have enough down payment, though they don't have enough equity capital. So that gap tier could be covered with mezz debt, or could be covered with preferred equity. Typically, on a risk reward profile, if investors participating in that, they take more
Mm-hmm.
risk than the primary debt, but less risk as common equity. So the compensation has to be adequate or compensatory with the risk. So it's just a
Okay.
middle tier, that the best way to think about this. And where it's
Yeah.
applicable, we've seen it is in 2 forms. On new deals, quite often it happens that there's that the real gap between what the banks will finance and what the common equity will fund. So it needs to be covered. And we've seen a gap could be a temporary gap funding.
Okay.
It could be a permanent preferred equity on a deal. Happens all the time on deals that look to write, for common equity investors that don't have enough capital. They need pref equity to come in, take less risk, but it takes some upside in the deal, but
Yeah.
that can enhance the returns to common equity. So the benefits of mezz debt or preferred equity on new deals It's just a higher return target for common equity, a little more risk, but it actually makes the deal happen. On existing deals from time to time, the liquidity is strapped and raising capital is hard, and there needs to be more capital to finish the work or whatever the business plan. And new investors, when they come in, they're not going to come in behind existing common equity. They're not even going to come in pari passu or on the same level of participation as common equity. They want to come in between to take less risk. So this is where preferred equity or mezzanine debt kind of carved its space in the current environment.
Yeah, yeah, I appreciate that. But then right? So how should investors approach the debt versus equity decision, considering all that in this climate of, to me, you can apply either one in really any economy if the terms are right, if the circumstances are right. But what would you recommend to people today?
Sure. So there's no right or wrong solution, but there are different options. And folks should really understand kind of what they're investing into and the level of risk. And I'll say this, I'm literally writing a new book, and I'm on a chapter discussing the capital stack. And some people think categorically, firstly in mortgage or primary debt is always safer and lower risk than common equity. And I'll beg to differ. It depends on the project. On the same project, yes. If you're on primary debt, you're taking less risk than the common equity, or if there's something in between, then that's a deal by deal specific. But we've seen plenty of deals where you could be in debt and take on more risk than in common equity on another project. It's a function of what you're investing in. And there's been a lot of discussions how to generate yield today. How did you generate good current income today? And many people have gone into private credit or first lien mortgage. They basically participating in the lending part of the either through a lending fund or in some cases given even a private note on a property. You could be a lender. You have some level of capital you want to deploy. You'll make a private mortgage and you'll charge 9, 10, 11% rate. You're collecting interest and you're feeling relatively safe. So it's definitely a play that some folks participate in. On the other side, you could be on a absolute triple net industrial and a common equity. You're an equity stack, but you have a long-term, high credit quality tenant with very predictable rent escalation clauses. Every year, rent goes up 2 to 3%. You have a 65% loan to value mortgage. You have, long-term fixed interest rate, a lot of predictability. So how do you get yield? You can do both. You could do it through, as I mentioned, absolute triple net industrial, open air shopping. There are strategies on the income front. As interest rates rose, the cap rates rose too. So people are buying these assets at a higher cap rate and still financing them at a pretty good mortgage rates. So we find both sides of the spectrum is pretty popular today, where there is a kind of risk avoidance or risk aversion through either private credit or industrial or open air shopping or other deals that have a strong spread between a cap rate. This is an example. We're working on an industrial deal right now. The cap rate is 8.6%, and the mortgage rate on a fixed rate debt is 6.3%. That's over 2% positive spread. Just an example. How do you generate cash flow? You have that spread and a margin of safety. So this is how we think about it today. Or you could be in the mezz debt. And in a mezz debt on a deal, if you're somewhere in between, you can get pretty decent current yield and you can get some level of back-end yield or some equity participation as well.
Hey there, did you know you can join a free real estate mastermind session every Monday night? It's called Monday Night Live, and it kicks off at 7 p.m. Eastern. I'm Gary Wilson, and every week I host this live class, joined by investor agents from across the country and around the world. And here's the best part. No selling, no recruiting, just pure, actionable real estate education. Every Monday, we cover everything from the basics to advanced strategies. We even bring in expert guests once or twice a month. Topics like how to buy property using crypto, how AI is reshaping the real estate landscape, what the metaverse and blockchain mean for real estate deals today. Whether you're a new investor or a seasoned pro, you'll walk away with real value, and you'll have the chance to ask questions live, connect with others, and expand your network. Sound good? Then head over to realestatewithgarywilson.com. Click the Resources tab, select Monday Night Live, and you'll find recent replays plus a full schedule. You can register for any upcoming session, even weeks in advance. And if you're watching this on social media, just check the video description for the direct registration link. I'll see you Monday night. Bring your questions, your notepad, and your drive to grow. I look forward to connecting with you.
Yeah. There's also there's some great alternatives too for people when it comes to, let's say they buy a property, and they've got to finance, the cash flow is tight, but really like in New York where you are, it's more of a capital appreciation play anyways than a cash flow play. But so you let it appreciate, pay down the debt, and later on when you sell, you can exchange it, 1031 exchange into another physical structure. But you can also then go into Delaware statutory trust. You can go into a qualified opportunity zone investment. And you can exchange into them just like you exchange into an actual physical property. So there's lots of ways to make the money and keep the money. But when it comes to the classes, the asset classes themselves, multifamily, industrial, office, retail, positioning wise, where are you today on those classes? If you want to take them one at a time, most people are familiar with multifamily because that's how most people get started. But industrial can provide some tremendous gains. There's some tremendous risk too. But between multifamily, industrial, office, and retail, how are they looking? How do those look today as far as positioning, and what kind of positioning are you doing in your funds?
Sure. So let me quickly comment on your first part, and it's exactly what you said. There are multiple strategies to mitigate gains. By the way, very, very popular source of capital that we see today. Many folks sell appreciated assets in coastal markets and do 1031, and you can 1031 as a tenants in common into an industrial deal or open air shopping. It just has to be a big enough check. The 1031s don't really work with small checks, but you have definitely that option. And then DST is obviously a consideration for some folks. Another way, folks, we've seen people, they go into deals that provide heavy fresh depreciation. So they offset gains from sale through fresh depreciation because both are passive gains and passive losses. And you can combine some of those strategies together. You could do 1031 and collect fresh depreciation. So everything you said there is great. But let me comment on various asset classes. So multifamily was a darling for many, many years of commercial real estate investing. For many years, people have done remarkably well until the market reset very violently in 21 and 22 because the cap rates were low, prices were high. The Fed artificially kept interest rates too low. That reset has been 20 to 40% depending on the property. And today, multifamily, many of these deals trade at a great discount. We did a deal early in 2025, in February, where we bought multifamily property near Ann Arbor, Michigan, on a lake, actually on the Belleville Lake, at 9% cap rate. 9% on a multifamily. It's a great asset and financed with 7%, and it was just a great cash flow from day one. And that discount to the peak of the market was about 35% of the peak. So as you go through these considerations, you could find a great deal if you can actually get it. Multifamily could be a great deep value buy today. But there are some challenges in that asset class simply because a lot of investors are scarred. Literally, they wrote checks. Some stories are just crazy. And I want to just give folks one story that I've heard, and it is almost staggering. People double their money every 3 years for 9 years. So you went from $1 million investment in 2013. 9 years later, you have $8 million in equity. And then imagine you roll all this equity through 1031 in 2022 in a new multifamily deal. And the deal is now going completely sideways and maybe falling apart. These stories are unfortunate, but they're real. And the reason I use this example is people should always remember diversification. Whatever has worked in the past may not work in the future. And prudent diversification makes a lot of sense. So, but let me cover other asset classes because I wanted to give this story that it's very real and a lot of people are hurt and scarred. And many retail investors just basically are stepping away from multifamily simply because they're so hurt and scarred that it's difficult to write a fresh check. So the
Yeah.
capital raising has been very much struggling unless you have a phenomenal deal and you can really show this is a new home run and people got to have courage to act even though they have problem situations. Now let's shift to open air shopping and industrial. We've seen phenomenal, strong performance with very limited supply. Oh, the other issue of multifamily, it got overbuilt. So some markets got really overbuilt and you have negative rent growth. So on top of all the challenges from financial pressures, you have significant negative rent growth, and a lot of these projects struggle from that perspective. Open air shopping and industrial, we've seen rental rates continue to escalate very healthy escalation in those asset classes for many years. Supply has been very limited. It's been very limited new construction of retail, and industrials also seen pretty limited new supply, and as a result, healthy rates, and most of those deals have always been acquired on conservative leverage, fixed rate debt. So this strategy has worked really well in the past. We're finding today it still works remarkably well, but now you can actually get the same deals, but at a lower prices per dollar of income, higher cap rates. Why? Because they trade on a pretty steady spread between the cap rate and the interest rate. It's about 1.5% to 2%. So when their interest rates were low, the cap rates were low, and as interest rates rose, cap rates rose. So you see that same strategy continues to work, and if interest rates come down, you have great downside protection from the structure, plus you can get a tailwind from the low interest rates. So we find those two asset classes very attractive today. I'll comment on a couple of other strategies. So storage, I've seen problems similar to multifamily. Once storage gets overbuilt, the market gets oversaturated, you have price wars. REITs fighting fiercely to keep the occupancy high, and it's all local. Every market varies, but storage, it's difficult to find great deals. And we've been looking. I can't find a deal with a positive spread between the cap rate and the interest rate. The cap rates that are still dominating the space, they're too low. And as a result, we haven't found anything super attractive. So kind of those comments. There are other asset classes. We've done some niche lending, etc. But there's, senior living, car washes, but they're more operating businesses. So to us, it's not classic real estate. It's half, maybe 3/4 operating business and 1/4 real estate. So it's not as easy to write a passive check because it very much depends how well it's operating.
Yeah. I know a lot of people fortunately got into the car washes a couple of years ago. They're doing quite well. But you're right. It's not just pure real estate. You're running a business in it too. So let me ask you this: when it comes to the funds that you've run, you have syndication. So you've got the Tempo family. You've got the what I would call the Big Mike Fund. When it comes to syndications, well, let's do this. What's the best approach for investors when they're looking at when they're evaluating syndications? Let me put it that way. When you're evaluating syndications, real estate funds, what's some of the key indicators? What are some of the flags and some of the key indicators that they should be looking for making their decisions?
Sure. So we've seen very significant shift, and this is kind of interesting. Investors choosing funds to choosing individual deals. And it actually makes a ton of sense. And some folks continue to say, well, the funds is a better option, but we, at least in our observation, the reason people are shifting to syndications because they want to really get clarity what they're investing into today. When people write a check into a fund, you're basically buying into a fund portfolio. And imagine a fund has been around for a few years and some of those deals have challenges. So a lot of funds struggle with clarity or valuations of the past deals. Some are easy to value, some are pretty hard. So the whole fund space has been affected by the past challenges in the industry. So as an investor, from an underwriting perspective, if I look at another fund, my first question is, do you guys have any challenges from the last couple of years? And if you do, then it becomes very difficult to evaluate the fund, whatever the strategy, right? So the better way to do this, you either start a brand new fund with no legacy issues, or you go into individual deals, which is way easier to underwrite. And of course, the underwriting of deals still starts with the same concepts. Jockey ahead of the horse. So you're always investing with somebody first. Who before how? Who before what? You're investing with a team. You're investing with an organization. You're trying to understand who you're investing with, how they think, and if in this environment somebody tells you everything is hunky-dory and perfect, is their name Bernie Madoff. So it's one of the other questions to ask, hey, have you guys had some challenges in the last couple of years? These are very relevant, very real questions, and the answer better be, yes, we've had some challenges because everyone has, right? And those who claim to have no challenges, I don't believe them. So back to the deals and then operators, right? So you definitely want to understand who you're investing with, what they're investing, what markets, what strategies. Do they have a legacy portfolio of assets to manage? Do they have problem assets? Because it's going to take some time and effort from them. So all these questions matter to understand their capacity to do new deals, their kind of financial position, as well as where they operate. So we definitely, these are some of the basic questions you can kind of go through, but first you're underwriting the jockey, then you started to look at the deal, right? And the deal-specific underwriting requires, of course, pretty clear understanding what kind of strategy. We will never write a check if we don't understand how the deal makes money. And today, predictability is much more important to me personally than, well, we have this really great, build this property from ground up. A lot of it is speculative and you're assuming future rents and you don't know where things are going to go. But if you're getting into a deal today at a great price with a great long-term tenant or set of tenants and predictable leases, I feel a lot safer personally. It's different strokes for different folks. But today, the shift has been from, heavy value add, hopefully that can execute, to more of a, how can we get the upside when the market recovers, but take a lot less risk simply by buying well in the right markets and strategies. So, and then finally, there's a third element, right? Terms. And because we do a lot of the investing ourselves, we negotiate terms kind of like, I'm a big guy. People call me Big Mike. I'm 6'4". So when I'm being this big guy, I step on people's toes. As I crack in the joke, and as a big guy, I can step pretty hard. The idea is, if you are writing a check, you definitely want to get really good terms. So the days of what I call the mom and pop waterfalls, non-institutional quality offerings, it's way harder to sell. So we're doing a new deal. We're giving investors 10 pref and a 90-10 split. Used to be years ago, people would get 7 pref and a 60-40 split. So just this is an example. Investing has changed with times. As an investor, expectations should be for better terms for investors in this environment.
Yeah. Well, I appreciate that. The reason I brought that up is I know there's a lot of people, when they really realize what's involved with identifying potential properties to buy, analyzing them, negotiating, closing, all that, it's a lot of work. I mean, I'm not opposed to it. That's how I get started. I'm where I am today because of all that I did years ago. But now I'm more passive. I would rather, get into syndications and as far as the exit strategy, we've kind of mentioned a few of those, Delaware statutory trusts and some others. It's just an age thing. If I was still in my 30s, I probably wouldn't be looking at DSTs. I would keep buying bigger buildings. But I'm not a more relaxed now. I love doing the podcast. I like teaching. I have a different lifestyle now. So syndications really work well for a lot of people, particularly people who are busy or just want more relaxed lifestyle. But how can people get a hold of? I mean, and by the way, is the Tempo family of funds and the Big Mike fund, is it two separate things, or is the Big Mike fund part of the Tempo family of funds? I'm curious because I've happened to notice there's two different logos, but very much related. So.
Well, TempoFunding.com is our corporate site. So we started in 2009, and we started originally with temporary funding, so it's called Tempo Funding. There's also Tempo Music, right? So depending how you look at this, we like both. So Tempo brand we've had it for a long, long time, right? So that continues to be corporate site, and completely separately, because people have called me Big Mike for many, many years. And I started a podcast with a cheesy name, Big Mike Fund Podcast, for no other reason that when I was in a mastermind group, I'm still in that mastermind group for many, many years. And one of the good friends in the group, instead of creating Wealth Show or some other, more, let's just call it professional name. I came up with a cheesy name, and my friend said, it sticks. It's easy. People will remember. So
Exactly.
that's the reason it's called Big Mike Fund Podcast.
Okay.
And the website is bigmikefund.com. And if you misspell it, you didn't hear me very well. You heard bigmikefund.com. You forget the D at the end. I promise it's not a kinky site.
Yeah. Well, I appreciate that. I really appreciate you having the time to give us on the podcast. And for everybody listening, if you're driving, don't try to write this down. We'll put it in the show notes. It's the website is tempofunding.com. TEMPOFUNDING.com. Just go there. You'll see how you can get a hold of Mike. Look and see what they're doing at the Tempo family of funds. I highly recommend it. Mike comes to me highly recommended, and for good reason. I always do my research, and you're doing a great job, Mike. I really appreciate it. I think that you're doing such a good job on the podcast, and I appreciate all you listeners out there. If you could leave a review, we certainly do appreciate that. And in the meantime, take care of yourselves. God bless you and all your loved ones, and we will see you on the next Massive Passive Cashflow Podcast.
Thanks for listening to this episode of Massive Passive Cashflow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.